Hello there and welcome. In today's video, I'll provide some crypto basics for beginners. Despite its well-known volatility, cryptocurrency is booming, and many investors are hoping to cash in on the trend. Cryptocurrencies like Bitcoin and Ethereum ebb and flow for a period before climbing higher, as do many other prominent digital currencies. Experienced traders have been speculating on cryptocurrency for years, but what if you're new to the industry and want in? So, I'll show you how to take a few baby steps to familiarize yourself with the crypto world. But before we go any further, please give this video a thumbs up and subscribe to the channel. So, with that being said, here are 5 steps to investing in cryptocurrencies. First and foremost, if you want to invest in cryptocurrency, you must have all of your financial life in order. That involves having an emergency fund, a sustainable level of debt, and ideally a well-diversified investment portfolio. Your crypto investments can help you diversify your portfolio and perhaps increase your total returns. Please keep these 5 more factors in mind as you begin to invest in cryptocurrency, guys. Number 1. Understand what you're investing in. Understand exactly what you're investing in, just like you would with any other investment. When buying stocks, it's critical to read the prospectus and extensively research the companies. Plan to do the same with every other cryptocurrency, as there are thousands of them, each of which operates differently, and new ones are generated every day. For each trade, you must comprehend the investment case. Many cryptocurrencies are backed by nothing at all, including neither physical assets nor cash flow. For example, in the case of Bitcoin, investors rely solely on someone else paying more for the product than they did. To put it another way, unlike stocks where a company's profits can expand and drive returns for you, many crypto assets must rely on the market becoming more enthusiastic and positive in order for you to profit. Ethereum, Dogecoin, Cardano, and XRP are some of the most popular coins. Solana has also proven to be a hugely successful coin. So, before you invest, make sure you're aware of the potential gain and risk. It's possible that your financial investment will be worthless if it's not backed by an asset or cash flow. 2. Let bygone be bygone. Many new investors make the mistake of looking at the past and extrapolating to the future. Bitcoin was once worth pennies, but it is now worth a lot more. The real question is, will that growth continue in the future even if it isn't at such a breakneck pace? Investors are interested in what an asset will do in the future, not what it has done in the past. What factors will influence future returns? Traders who acquire a cryptocurrency today need the gains of tomorrow, not the gains of yesterday. Number 3. Watch that volatility. Cryptocurrency values are about as volatile as any asset can be. They could drop rapidly in a matter of seconds based on nothing more than a rumor that turns out to be false. That can be advantageous for knowledgeable investors who can quickly execute trades or who have a firm understanding of the market's fundamentals, how it is trending, and where it might go. It's a minefield for new investors who don't have this expertise or the high-powered algorithms that direct these deals. Volatility is a game played by high-powered Wall Street traders who are competing with other wealthy investors. The volatility might quickly crush a novice investment. This is due to the fact that volatility frightens traders, especially newbies. Meanwhile, other traders may take advantage of the situation and buy on the cheap. In other words, professional traders quote-unquote buy low and sell high, and naive investors might quote-unquote buy high and sell low. Number 4. Manage your risk. You must control your risk while trading any asset on a short-term basis, and this is especially true with volatile assets like cryptocurrencies. As a beginner trader, you'll need to learn how to manage risk and build a strategy to help you avoid losing money, and this procedure differs from one person to the next. A long-term investor's risk management may simply consist of a never selling regardless of price. The investor's long-term mindset permits him to continue with the investment, while a short-term trader's risk management strategy can include establishing rigorous standards for when to sell, such as when an investment has declined 10%. The trader then follows the guideline to the letter, ensuring that a minor loss does not turn into a crippling loss later. New traders should consider setting aside a particular amount of trading capital and just spending a fraction of it at first. They'll still have money in reserve to trade with if a position goes against them. The bottom line is that if you don't have any money, you can't trade. Keeping some money in reserve ensures that you'll always have a bankroll to trade with. Risk management is necessary, but it comes at an emotional cost. Although selling a lost position is painful, it might help you avoid worse losses in the future. Number 5. Don't invest more than you can afford to lose. Finally, you should avoid investing money that you don't need in speculative assets. If you can't afford to lose it at all, you shouldn't invest it in risky assets like Bitcoin or other market-based assets like stocks or ETFs for that matter. The money you'll need in the next several years, whether it's for a down payment on a house or a major forthcoming purchase, should be stored in safe accounts so it's there when you need it. And if you're seeking a guaranteed return, paying off debt is your best bet. Whatever interest rate you pay on the debt, you're certain to earn or save. There's no way you're going to get lost there. Finally, make sure that any exchange or broker you choose is secure. Even if you legally control the assets, someone must secure them, and their security must be strict. Some traders choose to invest in a crypto wallet to keep their coins offline and out of reach of hackers, and others if they don't believe their cryptocurrency is securely secured. While investing directly in cryptocurrencies is the most common method, traders also have other options, some of which are more direct than others. Some of them include crypto futures. Futures are another option to bet on Bitcoin price movements, and futures allow you to leverage your money to produce big profits or losses. Futures are a fast-moving market that exacerbates crypto's already erratic movements. Crypto funds. There are also a few crypto funds, such as the Grayscale Bitcoin Trust, that allow you to bet on the price fluctuations of Bitcoin, Ethereum, and a few other cryptocurrencies. As a result, they could be a convenient way to buy cryptocurrency through a fund-like product. Crypto exchange or broker stocks. Investing in a company that will profit from the emergence of cryptocurrency regardless of who wins could also be a good idea, and that's the possibility of an exchange like Coinbase or a broker like Robinhood, which rely heavily on crypto trading for revenue. Blockchain ETFs. A blockchain ETF is a type of exchange-traded fund that allows you to invest in firms that may benefit from the rise of a blockchain technology. The best blockchain ETFs give you exposure to some of the most important publicly traded blockchain startups. However, it's worth noting that these companies generally conduct much more than cryptocurrency-related activity, diluting your cryptocurrency exposure and lowering your potential gain and loss. Each of these solutions has a different level of risk and exposure to Bitcoin, so make sure you know exactly what you're getting and whether it meets your needs. So, what is the minimum amount of money required to begin investing in cryptocurrency? In principle, investing in crypto just costs a few bucks. Most crypto exchanges, for example, have a $5 or $10 minimum trade amount. Other crypto trading apps may offer a lower minimum deposit. However, if you're trading tiny quantities of cryptocurrencies, you should be aware that some trading platforms will take a significant portion of your investment as a charge. As a result, it's critical to find a broker or exchange that charges the least amount of money. Many so-called free brokers, in fact, include fees known as spread markups in the price you pay for your cryptocurrency. However, you can also mine cryptocurrency yourself. Yes, you heard that right. How do you mine cryptocurrency? In a process known as mining, several cryptocurrencies reward users who verify transactions on the blockchain database. For example, as part of the Bitcoin verification process, these miners must answer extremely difficult mathematical problems. Miners receive a fixed amount of Bitcoins if they are successful. Miners require powerful processing units that spend a lot of energy in order to mine Bitcoins. To extract these benefits, many miners run large rooms full of such mining rigs. The Bitcoin system consumed as much energy as a medium-sized country as of early 2022. How does blockchain work? Blockchain technology drives cryptocurrency. A blockchain is a type of database that keeps track of and timestamps each entry. A blockchain can be thought of as a continuous receipt of transactions. When a cryptocurrency is powered by a blockchain database, it records and verifies transactions in the currency, as well as the currency's movements and who owns it. Decentralized computer networks are used to run many crypto blockchain databases. That is, the database is run by a number of redundant computers, each of which double checks and triple checks the transactions to guarantee that they are correct. If there is a discrepancy, it must be resolved by the network computers. Now let's talk about altcoins. What are they? An altcoin is a cryptocurrency that competes with Bitcoin. Many years ago, dealers used the phrase in a derogatory manner. Everything was defined in relation to Bitcoin because it was the largest and most popular cryptocurrency. As a result, anything that wasn't Bitcoin was put into the disparaging group of altcoins. While Bitcoin remains the most valuable cryptocurrency in terms of market value, it is no longer as dominating as it once was. Other altcoins, notably Ethereum and Solana, have gained in popularity, rendering the word altcoin obsolete. With an estimated 15,000 or more cryptocurrencies in existence, defining the business as quote-unquote Bitcoin and then everything else makes less sense than before. The simple fact is that cryptocurrency is a highly speculative industry, and many smart investors have chosen to invest elsewhere. However, the best advice for beginners who want to start trading cryptocurrency is to start small and only invest money that you can afford to lose. We have reached the conclusion of this video. Thank you for sticking with us to the end. If you found this video helpful, please remember to give it a thumbs up and subscribe to the channel. See you later. Bye.